Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Daybreak Weekend, our global look at the top stories in the coming week from our Daybreak anchors all around the world. Straight ahead on the program, a look at key inflation data in the U.S. and what it means for the Fed. I'm Tom Busby in New York.
I'm Stephen Carroll in London, where we're looking at how European efforts to attract foreign direct investment are hitting some turbulence ahead of a major summit in France.
I'm Brian Curtis in Hong Kong. We look ahead to big tech earnings in China and whether they might provide some momentum to recent gains.
That's all straight ahead on Bloomberg Daybreak Weekend on Bloomberg 1130 New York, Bloomberg 99.1 Washington, D.C., Bloomberg 106.1 Boston, Bloomberg 960 San Francisco, DAB Digital Radio London, Sirius XM 119, and around the world on BloombergRadio.com and via the Bloomberg Business app.
Good day to you. I'm Tom Busby, and we begin today's program with some key U.S. economic data out this week, including CPI, PPI, and retail sales for April. What could all this mean for Fed policy going forward? For more, we're joined by Edward Harrison, Bloomberg senior editor and writer of the Everything Risk newsletter. Well, Edward, after a dip to 3.1% in January, overall consumer prices in February and March, a little higher than forecast, a troubling sign. What do you expect to see for April?
Yeah, Tom, great to talk to you. I think what we expect on Tuesday, that's when the CPI comes out, the consensus is for 3.6% for the core and 3.4% overall. So core inflation has actually been running higher on average over the last year than CPI when you include food and energy, and because those prices have come down, and that's dragging the total down. But those numbers are really elevated relative to where the Fed wants to go. Now, last month we had a 3.8 number for the core number. This month we expect 3.6. So 3.8, terrible. 3.6, less terrible, but also not that great.
Well, moving in the right direction, at least. It's not close to the Fed's 2% target, but it appears to be moving the right way.
That's exactly right. And I think that, for the Fed, the real question is, and I think Jay Powell got to this last week, or the week before last, actually, when the Fed met, he was talking about we're not going to cut anytime soon. And so what they're looking for are two preconditions. One is exactly what you mentioned, Tom, which is that it's moving in the right direction. So what we want to see is that 3.8 number come down. But we also want to see that number be a lot lower. And so that's the second precondition that we haven't met. If we get to 3%, say, then I think you start thinking, wow, maybe the Fed has room to start cutting interest rates. So 3%, anything with a two handle, 2.9, 2.8, which we can't expect next week, but potentially down the line we can expect that.
Well, let's talk about the factors for this stubbornly high inflation. And I have to figure, you tell me, the rising cost of housing, buying, renting, whatever it takes. Is that the biggest one?
Yeah, that is the sticky wicket, so to speak. The real problem is, this is something worldwide that people are seeing is that we're seeing a shortage of housing. You could call this something that is a outgrowth of the great financial crisis, which was 15 years ago. But the pain from that crisis was so big for home builders that we had a dearth of building. And so now that the economy is back, there simply isn't enough housing to absorb the demand for new housing with this new cohort, the millennials, looking to now establish their own houses. And so that means that both buying and renting houses in the United States is going up. And that is sticky. That, along with services inflation, are the two things that are keeping the Fed on hold for the foreseeable future.
But if we do see inflation moderating, and I don't think that's going to happen anytime with housing, at the same time we're seeing signs that the U.S. labor market may be softening after April's jobs report, what does that mean for the Fed moving forward if we do see that?
I think, yeah, what they're looking for is the so-called soft landing. And when you can define the soft landing as, a growth that is below trend, and their trend they would consider, something in the order of 1.8% annualized. So let's say you have 1%, 1.5% growth, and you also have inflation declining towards their target. That would be considered a soft landing. And, we saw the jobless claims last week. They were showing us that we're moving in that direction. They were slightly elevated. It wasn't a terrible number. It doesn't mean that the economy isn't still making jobs, but it does give the Fed some thought that we're moving in the soft landing direction.
Well, let's hope. Let's hope. Now, one other data point investors get this Wednesday is retail sales for April. What do you expect to see there? And, with inflation, people pulling back spending, what do you hope to see?
I would say that's the big wild card for this week is the Wednesday number, because the prior numbers were 1% month-on-month increases. Even if you take out autos, we had 1.1%. We had 1.1 for the control group, which is sort of the thing that people look at the most. And that's a very high number. The expectation is it's for a mini increase, 0.1%. And if we go above those numbers, it's hard to say how the market will react based upon that. It could be that because the number is 0.2 or 0.3, the market's fine. But those numbers are above expectations. And so anything that shows that the consumer is actually still hanging in there more than expected, I think will be met with negativity by the market, because it would show that the Fed needs to be on hold for longer in order to bring inflation down.
Well, we've got a lot to look forward to. And our thanks to Edward Harrison. He's Bloomberg's senior editor and the writer of the Everything Risk newsletter. Well, we turn now to corporate earnings, and this coming week we hear from the home improvement retailer Home Depot on Tuesday and the world's biggest retailer Walmart on Thursday. So what will the results tell us about the health of U.S. consumers? For more, we're joined by John Edwards, Bloomberg News U.S. consumer team leader. John, thanks for being here.
Great to be here.
Well, let's start with Home Depot, the nation's biggest do-it-yourself chain. Mm-hmm. What are you expecting to see from Home Depot?
Well, last quarter they had their fifth straight decline in comparable sales, and it looks like they're going to have their sixth straight in this coming quarter. So we're looking at sales probably being down about 2% as they continue to just face this challenging environment. Consumers are pretty resilient, but also weary from the persistent inflation. It's obviously moderated, but it's not deflation. So people still remember when prices were lower, not that long ago. And so they're pulling back, especially on their big ticket purchases. And so Home Depot is going to continue to suffer from that. But, it does look like there's some, possible green shoots for them that could, perhaps lead to some outperformance. They had a decent discounting event, a sort of spring Black Friday event that ran through April. And that might help them a little bit on the sort of do-it-yourselfer end. And then, of course, there's their professional contractor sales, which are a big focus for them. And those are probably holding up decently.
Well, this time of year is when you spruce up the lawn.
Well,
it's
exactly.
when you start those projects. And when you do even just spring cleaning. Mm-hmm. Now, that has got to help them. But is it higher prices? Is it worries about the economy, about jobs that may be holding things back?
Yeah, I think it's all of that, and of course the sort of the housing situation itself, with existing home sales being relatively weak. So we'll look to see if that starts to bottom out, but we're probably not going to see that for this quarter that they're going to be reporting. So they're analysts are saying that things might start to look better for them toward the end of this year into 2025.
Well, you talked about how the housing market impacts Home Depot. We know from Whirlpool that said people are not buying these big appliances because they're not moving. Yeah. And these got to be high margin purchases for Home Depot. Mm-hmm. So is it just that? Is it barbecue grills? Is it is it everything?
Yeah, I mean it's a bit of everything, and you mentioned those big ticket purchases. Again, that is exactly what people are pulling back on, in part because they bought so many of those things during the pandemic as they were stuck at home and spruced up their homes because they weren't going anywhere else. And, so now they have things that, last, 3, 4, 5 years, and so they don't need to buy another one. So that's one of the things that they're running into. Still difficult comparisons, but again, that focus on professional contractors is sort of something that they're increasingly aiming at, and we saw that, of course, with their big purchase announcement of SRS Distribution, an $18 billion acquisition that they announced last quarter. So,
well, like everyone else, it's services. Services will lead you to the future. Well, let's move on to Walmart.
Sure.
So what do you expect to see in their results and their outlook for the rest of the year?
Yeah, so Walmart is looking like they will probably benefit from this environment as people start to look for value and perhaps trade down from higher priced retailers. So we are probably going to see their same store sales increase. It looks like the Easter season was pretty solid for them, and again with that sort of value seeking among consumers, Walmart tends to do pretty well with that. They are also looking at areas beyond retail to seek further growth. And they made an announcement of their own of an acquisition of Vizio, the TV makers. And some people were a little surprised, Walmart getting into making TVs, but this is all an advertising play. They have their internal advertising business, Walmart Connect, and Vizio, of course, serves ads to people who have their smart TVs. And so the idea
and a
is
streaming TV service that
exactly
it's all connected.
Yes, so that's so that's one area that the Walmart is looking at to sort of diversify and continue to build, even as they try to maximize their strengths with sort of general retail.
Well, a lot of big earnings coming up, and our thanks to John Edwards, Bloomberg News U.S. Consumer Team Leader. And coming up on Bloomberg Daybreak Weekend, a look at how European efforts to attract foreign investments are hitting some turbulence. I'm Tom Busby, and this is Bloomberg. This is Bloomberg Daybreak Weekend, our global look ahead at the top stories for investors in the coming week. And up later in our program, a look at some key tech earnings in China and whether they might provide some momentum to recent stock market gains. But first, European economies have seen a strong start to 2024 with signs of growth and economic activity picking up. And as the European Central Bank prepares to cut rates, leaders are looking to build on that momentum with foreign investment. French President Emmanuel Macron will attempt to woo international investors at this week's annual Choose France Summit. For more, let's go to London and bring in Bloomberg Daybreak Europe anchor Stephen Carroll.
Tom, born in 2018 to promote France as a business and investment destination, the Palace of Versailles serves as the opulent backdrop for Emmanuel Macron's Choose France Summit. Now in its seventh year, it brings global CEOs together with top-level French officials to encourage them, as the name suggests, to choose France. And it seems to be working. France recently has come out on top again in EY's FDI attractiveness survey, at least by number of projects rather than value. But that's led the French Finance Minister Bruno Le Maire to pat his government on the back for the economic reforms they've passed. But as our Bloomberg opinion columnist Lionel Laurent has been writing recently, that pitch could be hitting some turbulence. Political rifts between Paris and top corporate leaders seem to be on the rise. A widening gap between the US and Europe in terms of economic growth and approach to managing the energy transition, as the French oil major TotalEnergies threatening to unchoose France by moving its stock market listing across the Atlantic. Now, the economic outlook in France and across Europe just isn't as bright as in the US, and that's something that we've been discussing with Raffaella Tenconi, chief economist at ADA Economics.
France, in relative terms, definitely is in a better position than Germany. But a lot of the growth, to be honest, is in the periphery. Italy is surprisingly resilient. Greece is resilient. Eastern Europe is quite resilient. Given the weakness of the exports, in reality, the Union is not doing too bad. Of course, the critical ingredient here is lower rates. If the ECB does not cut rates, then we're stuck in stagnation, and then you will begin to see unemployment next year. But it appears the ECB has finally come around to the idea that 100 basis points of easing, that's our view, this year is tolerable, if not desirable. So that is enough to really reignite lending activity.
And so, to that, some of the fundamental challenges for Europe being low market valuations in Europe versus the US, really even more deep low valuations than we've seen in previous decades, and kind of geopolitical challenges from Ukraine to China. Xi Jinping's visiting Europe, and that's one of the kind of big issues that has held back Germany. And do you see that changing, the low valuation story? We're also still in an earnings recession in Europe.
Well, momentum is slightly more constructive because valuations are so low, and I think in any case there is a delta that is coming through. But structurally, Europe needs to address, the single market, needs to deepen the single market. So I am, for the first time in many, many years, I'm encouraged to see genuine political backing. There was the Letta report presented. Draghi is also pushing for that. And if the European elections in June go as the opinion polls signal, then you will begin to see deepening of the single market already next year, where retail participation also will become a better ingredient. And that is very important because, as I said before, European households have too much cash at hand. They're used to deflation. We are no longer in deflation historically. So not having a functioning capital markets is creating negative wealth effects.
So that was Raffaella Tanconi, chief economist at ADA Economics, speaking to myself and Caroline Hepker on Bloomberg Daybreak Europe. So is foreign investment then Europe's ticket to economic acceleration? I've been discussing this with Bloomberg's Europe correspondent at large, Alberto Nardelli, and I started by asking him why foreign direct investment is so important in Europe right now.
I think if we look at the current geopolitical climate and economic climate around the world, it's very significant. So you have like a contest almost between the US, Europe and China trying to attract or lock in investment in their respective geographical areas. And Europe is a bit struggling in this sense right now because its strength has really been this international rules-based order. So Europe is strong when everyone plays by the same rules. But in recent times, we've seen a protectionist really shift in the United States. China doesn't really play by those same rules, and Europe is kind of stuck in the middle trying to figure out, on the one hand, trying to defend and push for the rules, on the other hand is trying to change its models to adapt to this new world. But this takes time and is difficult in a continent of 27 different countries with different politics, different views, to come up with a united position on how to deal with these issues.
Yeah, and of course we've seen some of that play out in the recent trip from the Chinese president visiting France, Hungary and Serbia, notably, with each of those individual governments very keen to try and attract attention from China for investment. Do events like Choose France help when it comes to boosting a country's individual profile?
Absolutely. I think if you look at the specific French initiative, what sets it apart from other similar initiatives, say in other European countries, is really the profile of the event. Because most countries have FDI forums or events to try and attract business and investment, be it something specific like, startups or emerging technologies or bilateral relations with a country. The thing that's kind of different about the French initiative is its profile, the pomp and
not
marketing around it.
Versailles.
There's also substance, but other events have substance. It really is the profile that sets it apart.
Does it help to counter a negative image that France has, and the President Emmanuel Macron has really struggled to try and combat this, of it being a difficult place to invest in, a difficult place to do business, something that's often levelled by international investors at many parts of Europe because of it being a regulatory powerhouse?
It does, in the sense that, so on the one hand, there have been reforms in France, corporation tax, there have been tax incentives for R&D. It's easier to set up companies now. There's lots of, they're trying to cut bureaucracy. Lots of the other difficulties remain. So communicating those changes definitely helps. The other thing which I believe is kind of helping France is the fact that it has long pushed this idea of European sovereignty, and that idea often fell on deaf ears, but because of a changing geopolitical context where the United States, for example, is taking a more robust approach to try and onshore investments and rely more on its own components and raw materials and so on, Macron's view of the world has more appeal now than it did, say, a few years ago. On the flip side of that is many times other countries perceive when Macron says we must do more in Europe, etc., he really means France. And there's a bit of skepticism in other countries around this agenda.
Is there a lot of inter-European competition for investment? You know, is France sort of slightly eating the lunch of its neighbours as well and holding an event like this?
That's a very good question. It's actually one of the biggest debates right now in Europe because, for example, if you take state aid, there's a debate in Europe that rules around state aid should be loosened so that governments can invest more in critical sectors, because that is the only way to compete with China and the US and others. The challenge with that approach, however, is that a country like France or Germany, they have resources that a country like Latvia or Estonia don't have. So the risk is that it distorts the internal European market. So right now you have some countries which have focused very much on the innovative, on the cutting edge, and they've really attracted investments in those sectors, say drones in Latvia, for example. When a giant, compared to them, enters that same space, they can put up a lot more state aid investment. So if you look at where chip manufacturers or electric vehicle manufacturers are setting up shop, they usually tend to go to France, to Germany, rather than other countries. So that's the challenge.
This is something that Enrico Letta brought up also in his recent report, looking at reforms to the internal market in the EU. Is there appetite at a European level to try to counterbalance some of that?
I think this reform of the single market, let's call it, in areas such as defence, is going to be one of the biggest debates once the new European Commission comes into play. And the challenge is, the short answer to your question, is there appetite in Europe? There is appetite, and there is a realization that there isn't really a choice. Like there is a war on Europe's doorstep. Europe has to reform its defense industry and the way it functions. However, there are lots of buts in this debate. So countries will say, yes, we want to do this. However, we don't want to do, for example, joint borrowing. But those voices don't often say, well, where are we going to find at least 100 billion euros to invest in our defense industries if it's not through joint borrowing? Other countries, such as France, say, yes, we must invest in defense, but we must invest only in European companies' supply chains, etc., etc. So again, it goes back to this, do you really mean France when you say this, rather than looking at what is the actual defense need that Europe has as a whole. So it's a very complicated question.
As with everything in the European Union, it gets very complex when you have 27 people sitting around a table. How much has the Inflation Reduction Act in the US and that massive amount of spending changed the conversation around that in Europe, and does it add to a realisation that something has to be done at a broader level rather than an individual country level?
It has changed the debate dramatically. So first of all, Europe was mostly caught by surprise in terms of the specifics. There was, secondly, it had an impact on the relationship, at least in trade, between the European Union and the United States. So had there not been Russia's war against Ukraine, the EU would have sued the United States at the WTO, would have been a lot more assertive in its response. And the only reason it didn't is because it wanted to maintain unity around Ukraine. It has started to respond, so it has loosened some state aid rules in key sectors. It has worked very hard to try and get some concessions from the United States, but these concessions have been really limited. And it has created this debate, as we were saying before, about can you remain a pure champion of a rules-based system when not even your closest ally is prepared to play by the same rule.
Thanks to Bloomberg's Europe correspondent at large, Alberto Nardelli. I'm Stephen Carroll in London. You can catch us every weekday morning here for Bloomberg Daybreak Europe, beginning at 6 a.m. in London and 1 a.m. on Wall Street. Tom?
Thank you, Stephen. And coming up on Bloomberg Daybreak Weekend, a look ahead to some key tech earnings in China. I'm Tom Busby, and this is Bloomberg. I'm Tom Busby in New York with your global look ahead at the top stories for investors in the coming week. China's stock markets have enjoyed a significant rally in the first part of this year, and events in the week ahead will help answer the question of whether that can continue. For more, let's go to Daybreak Asia co-hosts Brian Curtis and Doug Krisner.
Tom, Chinese equities have bounced back from multi-year lows, and recently the major benchmarks entered a bull market.
To be fair, those benchmarks still are below their 2021 highs by some 40 to 60%.
But there's no denying the recent recovery, and it may still have legs if China's tech giants can deliver on their earnings in the coming week.
Heavyweights Tencent and Alibaba will both publish results on Tuesday, followed by JD.com and Baidu 2 days later.
Those four firms alone account for more than a quarter of the MSCI China Index. Earlier, we asked Julia Wong from JP Morgan Private Bank if the tech earnings might be a catalyst for further gains.
I do think that investors' sentiment towards big tech in China has already warmed quite a bit. There are things that we know, like gaming, for example, the regulatory process worked a little better. So all of that gradually has, dripped through to markets and probably are in the price at this point. So we do think that earnings, of course, are important, but we do need to see a sustained turnaround in their guidance for the next few years for the market to do even better from where it is today.
For a preview of what we might expect, we're joined here in Hong Kong by Robert Lee, Bloomberg Intelligence Senior Analyst, and Sarah Zheng, Bloomberg China Tech Reporter. Welcome to both of you. Thanks very much for joining us. Sarah, let me go to you first. Is it fair to say that the big tech companies do need to show some progress for this rally in equities to move forward, or are there other sectors taking leadership?
Definitely. I think tech will be the heavyweight that will determine whether or not we'll see this rally continue to go forward. Obviously, because this industry spans so many different areas, online sales, advertising, games, it's definitely been used as a gauge of where the Chinese consumer sentiment is, and if we're really seeing a recovery that we have been expecting this year. So it will depend very heavily on how Tencent, Alibaba, and also JD.com and Baidu report next week.
Robert, I'm wondering whether we need to consider the fact that these companies may miss on their results. I mean, if you look back at what happened, let's say, as an example, Tencent, I believe, the numbers that the company reported for the fourth quarter failed to meet expectations. So what happens if there is a miss?
Most of these businesses are quite seasonal in nature. So typically Q1, which is what they're about to report, is a weaker period. So the Q2 guidance as things pick up on a seasonal basis is absolutely going to be key and crucial. But I think taking a step back from that, the China market has been, and Hong Kong market have clearly been decoupled from NASDAQ and most other Western markets for some period of time. You haven't seen foreign investors participating. They've been sat on the sidelines or, for whatever reasons, have not been actively in the market. So we're beginning to see signs of investors and overseas investors coming back to the market. So I think, obviously, fundamentals and guidance is key, but I think the bigger thing to keep this rally going is ongoing participation or growing participation by foreign investors perhaps fear of missing out, for example, because as the index continues to rally, or assuming that happens, then this fear of missing out, I think, will be potentially a bigger factor that could draw more people into the rally and, make it more self-sustaining, perhaps.
If we look at the consensus estimates, Tencent is forecast to have a 6% increase in revenue, and Alibaba just under 6%. That, Robert, doesn't sound like the Tencent and Alibaba of yesteryear.
Absolutely. Both companies and the issues impacting Alibaba are perhaps somewhat different, given the competition that's suffering from low-cost disruptors, like Temu, for example, affecting Alibaba. But both companies are in a more mature phase of development. Some of that reflects the slower economic outlook within China, but they're mature businesses now. They're very large, broad spread businesses. So, like a river entering the more mature phase, you would expect the growth for them to be at a more modest level. But there are some structural issues different for both companies that are also, I think, impacting. Give you a quick example, saturated markets. Again, when China's core markets were building out in the first place, you had a multiplier effect, which really drove their growth. But now, because the economy is very well developed on the technology side and the markets are quite well saturated, competition is more of an issue, and in a slowing economy, that is impacting or is a headwind for the growth of both companies.
Sarah, I'm wondering whether we need to address the regulatory regime. We heard from Julia Wong a moment ago. She mentioned games. When I think of games in China, I think of Tencent. This is something, obviously, that the government has had a hand in. Is that cloud lifted completely from the market, or do we need to consider the role that the government may play in the way in which some of these companies are managed going forward?
Over the last few quarters, we've seen management from both of these companies that we're talking about, Tencent and Alibaba, say that the regulatory environment has stabilized to some extent. But then again, we also see that investors are still reacting to regulatory changes. For example, late last year, when they had draft gaming curbs, the market just reacted very strongly, Tencent, NetEase, and other gaming companies falling quite substantially, and that only swinging back earlier this year. So I think investors are still quite skittish about this, but from the broader outlook point of view, we have seen the regulation stabilize to some extent, even as those fears continue to linger and to shadow over these companies going forward.
Sarah, earlier Doug asked about CapEx and about expanding, but there has been some room for cost reduction of late for some of these companies. Does that continue?
Yeah, we've seen over the past year a lot of these companies focusing very heavily on cost reduction, including layoffs, massive restructuring. I think Alibaba is a very good example of that. After their sort of chaotic year-long restructuring, we saw that now they're streamlining their focus to just focus on their core businesses, so domestic e-commerce, international e-commerce, and the cloud side business, and then to just sort of shed some of their non-core assets, as they would describe them. So definitely these companies are thinking still about how to streamline costs, how to focus in on the areas where they can actually start to achieve growth, especially, as Robert mentioned, with the domestic environment being so competitive, really looking overseas or to other new areas to still retain some of that growth.
Robert, as Sarah mentioned, that these reports may give us a little bit of insight into the health of the Chinese consumer, and I'm wondering whether we need to take a step back and look at the macro. We know that the real estate market, the property market in China is still been a drag on consumer sentiment. Give me an understanding of where China is right now in its recovery and how that may manifest in the numbers we see in the week ahead.
Okay, so I think the e-commerce players such as PDD and Alibaba are probably more exposed to the pressures that were within the domestic economy. But as I mentioned earlier, economic growth in China is slowing. It still is outperforming most other developed economies, but it's entering a more slower phase. And so what we're seeing is rising competition, particularly again from these low-cost disruptors, the Temus and Sheins, both within the domestic China market and overseas, which are undercutting the whole business proposition of established players like Alibaba. So the competitive dynamics, I think, is being in focus and will remain so on the e-commerce side for some time, again, given the backdrop of slowing economic growth and, as you said, the pressures from the property sector.
Robert, it seems like there's a lot more up-and-coming competition for Alibaba than perhaps there is for Tencent. Now, I note that you are expecting a 32% increase in net income for Tencent, and that is presumably, I mentioned earlier that Tencent, the average forecast was only for a 6% increase in revenue. That's pretty interesting. So how does Tencent get to a 32% increase in net income with revenues only up maybe 6 or 7%?
Very good question. I think some of that's a base effect because, again, Q1 compared to last year, the economy was just reopening at that point and recovering after the COVID lockdown. So base effect is one part of that. And as Sarah referred to, I think the companies across the board have either been cutting costs, managing costs, or keeping costs flat. So there has been revenue growth in all companies, and with the sort of natural operational gearing that's there, then that will drive some margin increase and hence drop through to the bottom line. But for a company like Tencent, they're pushing into short videos. Their AI business is still at a very early stage, but they are applying their large language models to help enhance their advertising offering, and there is evidence of that coming through. And that's much higher margin business. So you've got a mix shift to higher margin revenue streams. So a combination of all three, base effect, cost moderation or cost rationalization, and the mix shift towards higher margin is really what's driving that.
Sarah, it wasn't that long ago when we were discussing Alibaba and the spinoff of the logistics arm, Sino Smart Logistics. Is there a sense now that that is dead in the water, that we're not going to get a breakup of these individual businesses within Alibaba?
Yeah, so that's the quite interesting thing, because actually literally 1 year ago, that's when Alibaba was announcing a very specific timeline for their massive restructuring and all the spinoffs, including what you mentioned, is the IPO of their logistics arm, Cainiao, spinoff of their cloud arm, and then also of the fresh grocery arm, Fresh Hippo. Of course, all of those things have now been put on hold. Dead in the water is kind of a good term to describe it. They've just said, oh, the valuation isn't where they want it to be, so that's not what they're looking at right now, and that's not their focus at the moment. And now we've seen Alibaba go from trying to spin off all their businesses to really focusing on their core business, as I mentioned. Cainiao, for example, they're buying the entire stake now in this logistics arm to be able to better service their domestic and international commerce side. So it's really focusing in on these businesses because they're realizing that they've just been bleeding money on some of these other, as they describe it, non-core businesses, for example, offline retail. And we've heard things about them exploring different sales of some of these businesses, for example, Sun Art and other businesses that they don't no longer see as profitable and necessary. So what we're looking to hear this time from their earnings is just a clear strategy direction for what we're going to see going forward. Now that they've sort of unwound their whole restructuring, spin-off sort of plan, what's the plan now to make sure that they can maximize the value from their core businesses?
I think we can agree that these earnings come at a crucial time for the Chinese equity market. Thanks to the both of you for helping us preview the week ahead and what we are likely to see from Tencent, Alibaba, JD.com, and Baidu. Robert Lee, Bloomberg Intelligence Senior Analyst, and Sarah Zhang, Bloomberg China Tech Reporter. I'm Doug Krisner, along with Brian Curtis in Hong Kong. You can catch us weekdays here for Bloomberg Daybreak Asia beginning at 8 a.m. in Hong Kong, 8 p.m. on Wall Street. Tom?
Thank you, Doug, and thank you, Brian. And that does it for this edition of Bloomberg Daybreak Weekend. Join us again Monday morning at 5 a.m. Wall Street time for the latest on markets overseas and the news you need to start your day. I'm Tom Busby. Stay with us. Top stories and global business headlines are coming up right now.